Hey, this is Edward today, and I want to record a video on valuing small businesses and how that works. And I want to give a little bit more nuanced of a topic related to that. That this is a more nuanced process versus you just looking at numbers and assuming things right away and deciding if it's a good multiple for a deal. So this video is designed for business buyers or people who are looking to buy up businesses specifically. So the question that I sometimes get from people is that they're looking at a deal, they're looking at the numbers, and they're asking me, is this a good multiple for this deal and the net profit we have? And in most cases, if this is your thought process you have when you're looking at deals, it is um, it's not an accurate question to ask when you're looking at deals. So in most cases, it's the wrong question to ask. So you need to be very nuanced when you're a buyer when you're approaching the market, right? Most of the deals we've done in the past are in between 250K in cash flow to up to 3 million in cash flow annually, right? So multiples can range in between even 2x. In some cases, we paid even less, and they can range up to 8x on the net profit. It really depends on what's included and what's the situation, what the deal is, and what the company is, and there's a lot of things that matter. Now, the reason this is not an accurate question is because the multiple of the net profit matters less if you can cover the debt or the costs, or if you can solve the challenges in the business for operations or with the cash flow of a business and essentially still get to your financial goals. If you can solve your goals within the deal parameters and you could cover the debt and you can cover all the costs and you can run the company successfully, I mean, that multiple doesn't matter as much. If it's eight or if it's two, where it doesn't really matter at the end of the day. So this completely depends on also financing structure and how you're getting financing. Are you getting a commercial loan? Are you getting an SBA loan? Are you getting an investor? How much are you going to pay the investor? How much are you going to pay the commercial loan? And how much are you going to pay yourself? And who you're going to need to replace in the business and such and such. And let's go into a more nuanced way of thinking and kind of like the elements that might define that value. Now, if you think about it, when you're negotiating with a company on a particular value, there's two sides of a coin. There's the realistic value from your perspective as a buyer, and then there's the realistic value from the seller's perspective. The truth is typically in the middle. The offer is going to get accepted somewhere in the middle, right? So you need to realize that this is not just about being analytical and looking at numbers and putting all the numbers together, modeling the deal, and doing preliminary analysis. But this is also not only a science kind of thing, but it's also an art to get to a point, to get to a negotiation done, and to agree to something. It involves also emotions and conversations and relationships, and that can get you to a particular result. So first things first is industry. So particular industries might have higher multiples of a net profit than other industries. An example of that might be an IT-based company or a cybersecurity company or a technology company or a company that has technology elements into it might have a higher multiple. A software as a service company might have a higher multiple in that net profit just because of the type of a business model they're in and the recurring business model they have. So now, if you're getting into a bad IT company or a bad SaaS deal, of course the multiple is not going to be as high, right? Because there's other issues within that business model that decrease that multiple, right? So it's not like you're going to talk to SaaS businesses, you're always going to pay a high multiple. It really depends. But an indicator is businesses that have technology attached to them and they're a lot more scalable, and industries that have a tech component related to them typically have a higher multiple. Um, so that's a big thing. As far as another thing that could give you an indicator of a multiple is you can look at like essentially analogy. So you're gonna look at other past deals that have been done. You're gonna look at current deals that are getting done. You're gonna look at the current market value, and you're gonna look at different price points at things that are close to that market in the same industry, of course. So let's say you're buying an air conditioning company in Florida. Well, if you're doing that, there's other air conditioning companies in Florida probably listed by other brokers, and you can get some insights on that. Or you can look up different tools like BizBuy Insights and listing data tools to be able to figure out what are the typical multiples and create some analogy within your deal and kind of get a sense of what is the ballpark of typical multiples in that scenario. Of course, the multiple is also going to be dependent on the amount of cash flow. If the cash flow is 250 versus 750, but 250 cash flow is going to have a lower multiple versus a 750 in cash flow. So the bigger the cash flow, the higher the multiple in the space, right? So you're looking for some sort of ballpark of multiples depending on what cash flow you're currently seeing the deal. That's really what you're looking for. Now, there's other things such as weaknesses of the business and moats around the business that is also gonna either increase that multiple or it's gonna decrease that multiple. So let's say we're in a business that has the customer concentration is a risk. There's only one customer and it has 80% of the whole revenue. Well, that's a weakness in the company that's typically going to derail the value of a company. Well, let's say there's another business that on the customer side, there's like 120 something customers and they're B2B customers, and the percentage of each customer is like a very low amount of the total revenue. Well, there's not as much risk, so that's essentially a moat around the business, which is a competitive advantage around the business versus that weakness that it has. Same goes with operations, same goes with brand, same goes with location, same goes with assets. If you're able to spot different issues right away in the sim, in the business model, in the conversations within that person, that broker, that seller, you can sort of see that there's going to be value points you can add to the deal, and you can subtract value points from the deal. So that's kind of a concept. So you're going to look at the industry, you're going to look at cash flow, you're going to look at analogies, you're going to look at strengths and weaknesses, and that's going to give you a better understanding of what's realistically happening from your perspective, right? Again, this is realistic value from your perspective as a buyer. Now, keep in mind that the seller has been building this business for maybe 10, 20, 30 years or even more. It's a family business for centuries, right? So now they've been passing this legacy from family to family. They have a fairly successful company, and their expectation is a certain value they have in mind based on maybe how they build this business, how much time they spend at the business, how they got educated by the broker as well as far as the value of the deal and so forth. So what the seller is willing to accept, that's realistic value for the seller. Yes, the seller's going to analyze the deal from all these financial perspectives with a broker, and they're going to get help on that, and they're going to get like an estimate value, and they're going to put that in the sim. But what he's willing to accept is actually the realistic value. And you might not know this number fully yet until you get to know the broker, until you get maybe a little bit more information, and you get to let them open up about that realistic value. Then it's important to understand what's actually included in the price point from their perspective. Do they really want to include real estate, additional assets, different things, right? Or they have different terms and conditions where they can exclude some of these things and you can lease them, or you don't need some of these additional things. So a lot of people look at the listing and they see the purchase price, but they don't read actually what's included in the purchase price. So what's included in the purchase price is of a very big importance when you're looking at value. And as I said, typically when you're negotiating with people, you're creating offers, you're sending an LOI, somewhere in the middle in between your value and their value is going to be where the offer is going to get accepted. If you've analyzed, let's say, the industry, you've analyzed different deals, You've analyzed your deal, the weaknesses and the strengths of the deal, and let's say you propose a particular value. And let's say the seller's never going to accept that value. Well, your valuation doesn't really matter at this point because even if you've done a lot of this effort and you scientifically proven to him that, hey, this is what a value is, why you're not accepting this value? Well, again, you got to remember that he has his expectation and his realistic value and what he's going to be willing to accept. And the best thing to do is to find that out and to understand how far are you from that and to understand if that is financially feasible. If you can actually get lending within these parameters, if you can actually get financing. So keep in mind it's a balancing act in between what you're trying to do and what they're trying to do to be able to succeed. So you need to have a very nuanced understanding about valuation to be able to actually get results within the ecosystem, within the space. If you want to get more specifics, if you maybe have a deal you're looking at and you want to get into more specifics, just send it over to me on LinkedIn, and I'm happy to look into it and to give you more value. But this was the whole video for today. Thank you.